focus on the returns on your money without worrying about the return of your money. For over 30 years, Brokers Alliance has maintained one of the largest inventories of guaranteed and tax-advantaged products in the country and serves a nationwide network of financial professionals. Call 1-800-290-7226 or email thequest@brokersalliance.com. And remember, when you need financial guidance, call Brokers Alliance.
Well, welcome back to the Quest for Financial Freedom. I'm your host, Steve Savant. And of course, with me today is my special guest on the Quest, Eric Palmer, one of the nation's annuity experts and claim to fame, 10 years playing the game. Hey, you can write us at the Quest at brokersalliance.com or call us toll free at 1-800-290-7226. That's 1-800-290-7226. In the second segment, we're talking about indexed annuities, but we're going global. Well, now we're talking about worldwide indexing. I mean, I've lived to tell the tale, right? I remember when we stopped, everything was the U.S., the whole world orbited around us. Now, the world is shrinking. And now we're talking about global indices. I mean, Europe, I mean, China, I mean, Japan, I mean, emerging markets. I mean, think about when we get into that. And we're almost there now on this issue with insurance contracts, emerging markets. Talk a little bit about, nervously I say, global indexing, like, you know, the Euro 550 stocks.
Right. Global indexes are now being used as a benchmark because we are seeing them perform very well. They're increasing in terms of their exposure in the general marketplace when we're talking about investing in securities, and they're also emerging in the insurance products that we're dealing with when it comes to indexing. Because, and I'll use the Hang Seng as an example.
And that's Chinese.
Exactly, a Chinese index.
Wait a minute, that's communist China, by the way.
You know that.
Wait a minute. That's communist China, who we owe our life to in American debt.
Right, exactly. And now they're a part of our global strategy when purchasing index annuities for our own retirement. But the reason that we look at them is because those are, like you said, emerging markets. We're seeing very strong returns. You know, like any security or any indice, there's ups and downs. But there's strength behind the country, behind these indices, and that's what we see in these products that are being put out today. I'll give you an example. One of the most common things that we find with global indexing is what they call the basket. We're not just in one index, where you might buy an annuity here domestically and put 100% of your dollars in the S&P 500 allocation. In a global strategy, we're typically seeing them bundled together, so your eggs aren't really all in one basket, so to speak.
But, do you have a choice? You could buy the Hang Seng by itself, though.
In some product, it's very limited, actually. Right. You could purchase it, but typically we find it coupled with a basket feature, and they call it a look back. So in this basket, this global index, we have the Nikkei 225, Japan, the Hang Seng,
Chinese,
the S&P 500, and the Euro Stoxx 50. Now, that's a pretty good sampling of the strongest markets in the world, right? You got China, you got Japan, which is coming back a little, I guess I could say. Yeah, right. You've got the domestic, and of course, you've got Europe, and we take into consideration, all of these indices being bundled together, then you stand to gain on the countries that are doing well, and you don't take as significant as a hit in those that don't perform quite well. And what they do typically, I call it the look back. It's like betting on the horse after the race. The look back basically says that they're going to bundle those indices all together. You put your $100,000 in this product, and before they allocate the interest to you, they're going to wait a whole year. And then they're going to look back at the performance of all those indexes, and they're going to allocate your premium to the better performing indexes over that period of time. So what they're doing is they're saying, before we divvy up your $100,000, it's not going evenly into each one of these indices. What it's doing is we're going to look back and say the top 3 performing indices are the ones we're going to put all your money in. The one that didn't do so well, potentially negative, we're going to drop that out of the equation.
So they're going to take the best of what, 3?
The best of 3, sometimes 4. The baskets vary by carrier and product, but again, the idea is that by bundling it together like this, we're preventing the all eggs in one basket type scenario, where if it was all negative across the board, we're getting zeros, versus having 4 very unique indices participating together, we're potentially walking away with a gain more often than not.
Now, and some of these you can actually choose foreign and still keep the S&P if you want to have America in there.
Absolutely. We call it the blended strategy. You'll hear that terminology a lot, the blended strategy. And for our advisors, you may hear our internal folks talk about blended strategies. And what that is it's a blend between some of the domestic and some of the global indices. And you can put 40% of your money towards that blended option and then put the rest of the 60 in the straight annual point-to-point on the S&P. The idea is that you have the options and you have the choices.
In our last segment, we were talking about caps, a lot of them at 6.5. Are the caps different in globaling, or is it pretty much the same?
The caps are different, and we tend to find that the globals have longer-term reset durations. So again, we kind of talked about the 3 and the 5 years before, but the caps are 17, 20%. So they're taking into account there's multiple years here. You're not just getting that 6.5 I talked about earlier. You're potentially having a cap of up to 20% in some cases.
Well, why would I not go foreign then and ever play in the domestic because of the cap restrictions in the first place?
It's a decision that we all have to make in terms of our comfort level, but I think it really comes down to understanding the index first and then making the decision later. You brought up participation. Most often in the global, we find that participation is more common. Let me explain that. Instead of there being a cap or a ceiling on how well my annuity can perform, what they're doing is they're giving you a participation rate. They're saying that we're not going to cap this thing, but we're going to allow 65% or 60% of your original investment, your $100,000 that you put in this annuity, to participate in these global indices, and you're going to get 60% of that return. So if the 65% or 65,000 of my dollars are working in this index and it comes back when you're at a 40% gain, then that $65,000 got a 40% gain. So a lot of times I come across this a lot with folks that have existing variable annuity contracts. They really like the idea that they can get more than just a single-digit return. The participation is where you start to find that. If you can find a product that participates at a percentage with no limitation, no ceiling, then you could see double-digit returns in these products.
Well, I'm just curious, without mentioning the name of the carrier, and hopefully I don't have to speak a foreign language to get this done, but I'm just wondering, what's your top participation and top cap all in one contract? Who's got the top cap? Give me a number.
65% is your top participation, and I would say right now, top cap at about 7.5%.
7.5% on global.
Global,
Right.
Annually.
So you might get 100% of the S&P at 6.5, like we were talking in the first segment. The second one is only 65% because you're using this blended basket
Right, with no
mentality
ceiling.
With no ceiling. So that doesn't have a cap then.
Right.
Okay, so we have to kind of think. So if you had no cap, what was your in that scenario? What is your top participation? 65, you said.
65%, right.
So now you're looking at 65% of a capless rate. If we thought that the foreign markets are going to play, and some of these emerging markets are definitely going to be players,
Exactly.
that could be totally the way to go. Now we're talking about participation rate. You see anybody paying any floor rates? I know everybody says we won't ding you if we go south and we have a negative market, but do you see anybody giving you anything on a floor rate on these contracts?
There's always a floor rate on the contract, but usually you have to stick out the surrender charge to really see that actualized in terms of your account value. But most floors right now, on average, they'll read 1 to 3% on 87.5% of premium. So that means that you're going to average probably less than 1%,
Okay.
but it's better than zero. And if you wait out the 10 years, for example, if it's a 10-year product and the index got zero across the board, you still end up walking away with some gain.
So if I'm at, would you say 85%? And do you have a guy out there that's paying 3%? You have an index contract that's paying 3% floor at 85% participation on that 3%?
Not currently.
Not currently. So that was a one that they pulled that. Well, probably because they were subordinating 2.5%.
Right.
You know.
And the biggest thing is that something that we always have to keep in mind is that there's a lot of regulatory entities, the state, the NAIC, the federal regulatory entities that are out there. They're looking at annuities as well. They're not just ignoring it as the redheaded stepchild. We're highly regulated, and we have to file these guarantees with the state. So if an insurance company can't meet a guarantee, they have to pull the product off the market. And I think that's really important for people to know because it helps you sleep a little bit better at night knowing that your guarantee is also protected by the fact that the state's regulating that on a regular basis.
Well, they can regulate it, but that doesn't guarantee that the state has to back any of that up. That's for sure. So when we talk about indexing, and we're talking specifically in this segment global, do you think are we moving more towards that? I mean, you see thousands of these contracts every year. I mean, Brokers Alliance sells so much. Are we seeing a move more towards global? Our Americans, I guess I'm saying, are we okay with that? Are we moving this way?
I think we're seeing a move in more selection. It wouldn't necessarily mean that we're adding these options for Hang Seng or Nikkei and replacing S&P. I think we're simply adding options because what we've come to learn in this business is that the S&P has its years, the NASDAQ has its years, the Russell, the Dow, they have their years. And when we look historically, the years that they're not doing so well, a lot of times there is an international indice out there that's doing better. And so by providing those options to our clients, we're covering all of our bases.
Some of these index annuities that we've talked about also give you an option to buy an income rider on top of it. Now, I saw one in one of your briefs. I can't remember what the company was, but it doesn't matter. What about this idea that you can actually lock down an income? I thought I read the thing where it says I get 8%.
Yes.
That's 8%. I mean, is that bogus? Are they? I mean, am I high or what?
Absolutely not. One of the things insurance companies want to make sure happen is that clients are investing in them and staying in their products long term. Because as an insurance company, how can you provide strong guarantees if people are pulling their money out left and right every given year? So one of the things that they offer is a rider that you can add to these index annuities, especially that's where it's most prevalent, where aside from the growth that we've been talking about here with the indexes, you're guaranteed some bonus up front and what we call a roll-up, but it's an interest rate compounded for a certain number of years, most commonly 10 years. And 8%, you hit it right on the head. That's the top one in the market right now. And basically that's saying that if I give this insurance company $100,000, it's going to go to work for me in these indices I've chosen, but it's also going to grow at a guaranteed 8% for 10 years. And if I choose to take a systematic stream of income payments off of it, I get to use the pool of money that was guaranteed 8% growth. And right now, 8% is phenomenal.
And by the way, do I have to pay for that rider?
It does have a cost. The cost could be half of a percentage. So, we talk in the nomenclature 50 basis points, but half of a percent is usually the common number.
So if you're willing to pay a little bit extra of it, you're buying a little insurance here with the insurance policy.
Right.
I can sit there with an 8% in 10 years.
Guaranteed.
Now that's not the principal. That's just the number they'll use for your income calculation.
Exactly.
And you still have whatever you made on that return, so you can even elect later on down the road whether you're going to do this or not.
It's having the keys to the car and staying behind the wheel. For the client, they have all the options in the world at that point. They can take the income off of a very strong number, or they can do what I want to do and walk away and buy a boat. But the idea is that they have those options.
I want those options. Wow. Well, listen, I want to thank you, Eric, for being my guest today. Our sponsor, Brokers Alliance and America, where anyone can go on a quest for financial freedom. So until next time, remember what the good Reverend John Wesley once said. Make all you can, save all you can, give all you can. I'm Steve Savant. Join me next time on my quest for financial freedom.
Quest for Financial Freedom is brought to you by Brokers Alliance, the premier provider of guaranteed and tax advantage products to a nationwide network of financial professionals. Need financial guidance? Call Brokers Alliance. You can request an email link of this webcast at our email address, thequest@brokersalliance.com, or call us 1-800-290-7226. That's 800-290-7226. And join Steve Savant next time on the Quest for Financial Freedom in your lifetime.